This is an overview of Chapter 12, Intangibles. So we'll be talking about intangible assets, their valuation, amortization, and impairment, explain cost issues related to research and development, understand disclosures for intangibles, explain the accounting treatment for identifiable intangibles, including trademarks, trade names, franchise patents, copyrights, and computer software, and then for unidentifiable intangibles that are internally developed or purchased goodwill. So where's the value? Even though intangibles don't have a physical or financial nature, they can create enormous value for companies. With the move to a more knowledge-based economy over the last several decades, intangibles are replacing tangible assets as key value drivers in the economy. Intangible assets do not have a physical or financial nature, but they do have rights and privileges that convey to the company that owns and uses them. Intangibles generally have a higher degree of uncertainty regarding their future economic benefits due, in large part, due to their intangible nature that makes them hard to separate and sell relative to tangible assets. Intangibles that are externally acquired are purchased from others, either in a separate transaction or as part of a business acquisition. Purchased intangibles are capitalized at the cost to obtain them and prepare it for use. Intangible assets that are internally developed are generally expensed because the future economic benefits associated with them are difficult to measure, and the costs incurred to develop them are often difficult to measure or separate from ongoing normal transactions in your business. Identifiable intangible assets that can be separated from the company and sold, transferred, licensed, rented, or exchanged examples are trademarks, trade names, patents, copyrights, franchise rights, customer lists and relations, non-competes, and licenses. Unidentifiable are the ones that can't be separated. These are primarily related to goodwill. When you purchase intangibles, the companies account for the purchased identifiable intangible assets such as patent or trademark in a similar manner as tangible assets. A company capitalizes an unidentifiable intangible asset, which is called goodwill. Goodwill can only be acquired through purchasing another company. Internally developed identifiable. When a company internally develops an intangible asset, such as a patent, you can only capitalize certain costs, including legal and related costs of establishing and successfully defending your right to the patent, but not the costs leading to the development of the process. Internally developed unidentifiable. So a company expenses costs of an internally developed unidentifiable intangible assets incurred, even though they may be expected to have future benefit far beyond the current period. This is because either the cost incurred or expected life cannot be faithfully represented. So here's a chart of the classification. So purchased intangible assets, was it identifiable or unidentifiable goodwill? You capitalize it. There's a finite or indefinite life. So you would amortize this, and then goodwill you review for impairment. Then if it's internally developed, if it's identifiable, you could capitalize certain costs like part of the patent. And then if it's research and development, it's expensed as incurred, and if it's unidentifiable, it's also expensed. The allocation of the cost of an intangible is a systematic and rational manner over the asset's useful life called amortization. An impairment of an intangible asset occurs when the fair value of the asset is less than its carrying value. An intangible asset are separated into two categories: intangible assets with a finite or limited life, or intangibles with an indefinite life. An identifiable intangible asset with a finite life is amortized over its useful life. Factors that a company should consider in estimating its useful life of an intangible are expected legal, technological, or contractual life, expected use of the intangible, expected life of a related asset, legal, regulatory, and contractual provisions that enable renewing or extending the intangible's legal or contractual life without substantial economic cost, the obsolescence, demand, competition, and economic factors, and then the level of maintenance required for future cash flows. Here's an example. Schultz Company purchased a patent for $85,000 and amortizes it using straight line over 10 years, the period it expects to use the patent, with no residual. The journal entries are as follows: patent, which is an asset, credit cash, 85. Amortization expense, which is 85 divided by 10, so 8,500, and then patent, or accumulated amortization for the patent. The book value of $76,500 is reported as the intangible asset on the balance sheet. GAAP requires that a company review its intangible assets that are subject to amortization for impairment whenever events or circumstances indicate that its book value may not be recoverable. Testing for impairment of intangibles with a finite life consists of 2 steps. Step 1, recoverability test. If the total undiscounted cash flows expected to result from the use of intangible assets are less than its asset's book value, the company must recognize an impairment loss. Step 2, measurement of loss. The impairment loss is measured by the difference between the asset's fair value and book value. Here's an example. Because of technological developments in the industry, Schultz decides to review its patent, which has a book value of $68,000 for impairment. Schultz estimates the net future cash flows of this patent are $40,000. The fair value of the patent measured at present value expects its future cash flow is $25,000. Because expected future cash flow is less than book value, it must recognize impairment. So 25 minus the 68,000, which was on the books, is 43,000. So it's loss on impairment, debit, credit, patent. So you're reducing the value of the patent. An intangible asset with an indefinite life is not amortized, but reviewed for impairment. Intangibles with an indefinite life is impaired when its value is less than its fair value is less than book value. Norton Company has a trademark 2 years ago for $60,000. Norton considers the trademark to have an indefinite life and leaves a carrying value of $60,000. At the end of the current year, they determine the fair value of the trademark is $20,000. They record a $40,000 impairment loss. So debit impairment loss and credit the trademark. The impairment loss is a component of income from continuing operations and the income statement. The fair value is reported in the intangible assets section of the balance sheet. Subsequently, the company must compare the fair value with the adjusted carrying value if additional impairment has incurred. Goodwill is defined and measured as the excess of a purchase price over the fair value of acquired company's identifiable assets. Only recognized when you purchase another company. You can't just recognize or create your own goodwill. It's when you purchase another company. What do we do for research and development? Research is planned search for or critical investigation aimed at developing new knowledge that hopefully will be used in developing a new product or process or in significantly improving an existing product or process. Development is the translation of the research into a plan for a design of new products or process or significantly improving the product or process. GAAP requires that a company expense all of its research and development as incurred. Examples of R&D: laboratory research, discovering new knowledge, searching for applications for new research or other information, conceptual formulation and design of a product or process alternative, testing in the search of evaluation, modification of formulation or design of a process, design, constructing, testing, or pre-production prototypes or models, designs of tools, jigs, molds, dies that involve new technology, design, construction, and operation of a pilot plant that is not to scale economically feasible for the company's commercial production, or engineering activity required to advance the design of a product to the point that it meets specific functional and economic requirements and is ready for manufacture. Examples of things that are excluded: engineering follow-through in the early phase, quality control during a commercial production, including routine testing, troubleshooting in connection with breakdowns of commercial production, routine ongoing efforts to refine, enrich, or improve upon the qualities of an existing product, adaptation of existing capability, in particular requirement or customer needs, seasonal or other periodic changes to existing designs, routine design tool, jigs, and dies, activity including design and construction related to reallocation, arrangement, or startup facilities or equipment that pilot plants or facilities or other equipment sole use is in a particular research project, or legal work in connection with patents or litigation or the sale and licensing of other patents. The costs of the following elements of research and development are included in research and development and thus expensed when incurred: materials, equipment, facilities, personnel, intangible assets purchased from others, contractual services, and indirect costs. Research and development includes a reasonable allocation of indirect costs. However, general administrative costs are not clearly related to research, are not included. Kent Company incurred and paid the following costs for R&D. Material used in inventory, $50,000. Salaries and wages, $90,000. Allocation of general admin costs, $20,000. Depreciation on the building and housing of multiple R&D activities, 25. Machine purchased for R&D project, no alternative future uses, 30. If the machine has no alternative future uses, it would record the following entry to R&D. So research and development, 215. Cash, 140. Inventory, they would reduce by 50. And then accumulated depreciation for the building would be a credit. Here's another example. So let's say it's the same thing. If the machine had alternative future uses and was being depreciated straight line, Kent would make the following entry. So they wouldn't take the 215, they would just take a portion of the machine. So accumulated depreciation on the machine, which is the $30,000 divided by 5 years, or $6,000. When a company is performing R&D activities, it is acquired by another company. The acquiring company must allocate a portion of in-process R&D. In-process R&D is initially capitalized at fair value and treated as an intangible asset with an indefinite life until the R&D activities are completed or abandoned. In-process R&D is expensed immediately if the project is abandoned, otherwise accounted for as a finite life or an indefinite asset, depending on its nature. Startup costs are the costs incurred for one-time activities related to opening a new facility or commencing a new operation, introducing a new product or service, conducting business in a new territory or with an entirely new class of customers, or initiating new process in an existing facility. Startup costs include the organization, legal fees, stock certificate costs, underwriting, and accounting associated with forming a new company. GAAP requires that startup activities be expensed as incurred. How are these intangibles disclosed? At the end of the period, when a company presents a balance sheet, it should disclose the following: intangible assets that are amortized, the total cost, accumulated amortization, amortization expense, and the estimated amortization expense over the next 5 years. For intangible assets that are not amortized, the cost of each major class of intangible asset, and the total of identifiable assets are separated by line item on the balance sheet. For any intangible impaired other than goodwill, the facts you must include in the disclosure: the facts leading to impairment, the amount of impairment loss, the method for determining it, and any impairment loss should be included in income from continuing operations. At the end of the period, when a company presents a balance sheet, it should disclose the following: for goodwill, the amount of goodwill acquired and the amount of any impairment loss recognized. Any impairment loss should be reported as a separate item in income from continuing operations unless the impairment is related to a discontinued operation. If intangible assets are acquired during the period, GAAP requires a company to disclose the cost of intangibles acquired, the residual value and weighted average amortization for the period, the cost of any research and development and acquired and written off, and where it is included on the income statement. Identifiable assets can be classified into 5 basic categories: marketing, customers, artistic works, contracts, and technology. Marketing-related intangibles are resources used to market and promote the company. This would be a trademark or a trade name, a word or phrase or symbol that identifies the product and distinguishes the product from others, like the Michael Jordan Jumpman, right? Registration of the trademark name with the U.S. Patent and Trademark Office establishes a right to exclusively use the trademark or trade name for 10 years. The right is renewable as long as the trademark or trade name is used continuously. Internet domain names are names used to identify particular internet addresses. Then we have customer-related intangibles. These arise from the relationship with a company and its customers, such as customer lists, product order, backlogs, and customer relationships. If these assets are developed internally, the cost of developing them are expensed. If customer-related intangibles are purchased from another company as part of a combined business transaction, then the amount of purchase related to the intangible asset is capitalized. Customer-related intangibles are generally considered to have a finite life and amortized on a straight line basis. If you're talking about artistic-related intangibles, these represent the right to reproduce, copy, or perform artistic works. A copyright would be granted by the federal government, which gives control to the owner to publish, sell, or otherwise control for 70 years to the author. The cost of acquiring and successfully defending a copyright is capitalized. Under GAAP, increases in the market value of intangibles are not recognized on financial statements. Contract-based intangibles are the right to value arising from contractual agreements. These are franchise agreements, licensing and royalty, construction permits, broadcasting rights, and use rights. Franchise are contractual agreements in which a royalty percentage of sales, the franchisor gives the franchisee the right to use certain functions or sell certain products or services. A franchisee capitalizes the initial cost to acquire the franchise or license, but it expenses any continuing fees in subsequent years. A technology-based asset, intangible, represents technology advancement and provides economic benefit to companies either through legal or contractual obligation. A patent is a right granted by the federal government for the owner to control manufacture, sale, or use of an invention for 20 years from the filing date. If an intangible asset cannot be renewed, it has a finite life. In other situations, the effective life of the patent may be extended beyond 20 years by obtaining new patents or modifications or improvements on the original. Software development costs are software being sold, licensed, or leased by third parties, include designing the software, coding the software, and testing the software. GAAP requires these costs to be treated as R&D expense until technological feasibility of the product is established. Once it is established at that date, the company completes a detailed program or design in its absence when it completes a working model of the product. After this date, the company would capitalize all software development costs until the product is regular for general release to customers. So here's a timeline of accounting for software development. So they have R&D expense until technological feasibility, then they capitalize, then they have the general release, and then ongoing is just general expenses. Amortization is calculated as a grade resulting from either the percentage of revenue calculated as a ratio of current revenues for the software to the total amount of current and anticipated future revenues from the software multiplied by the asset, or straight line. An example of the software development costs. They develop a computer game. A new development project reached technological feasibility June 2019. The project was available for release in January 2020. The development cost prior to June was $1,600,000, and the costs incurred from July to December were $1.2 million. Revenues from the sale of the new product in 2020 were $4 million, and the company anticipates another $12 million. The economic life is 3 years. The $1.2 million incurred after feasibility but before general release should be capitalized. So the journal entry would be software development costs, $1.2 million, cash, $1.2 million. In 2020, amortization expense is the greater of the percentage of revenue method, which is 4 million divided by 4 million plus 12 million times 1.2 million, or 300,000. Straight line is 1.2 million divided by 3 years. So straight line is greater, therefore you take straight line. They would record amortization expense, so it would be debit amortization expense, credit software development costs. The costs that are incurred in preliminary stages of developing internally used software are expensed as incurred. Once the preliminary stage is completed and management agrees these funds development of the software, the company capitalizes the software costs. These capitalized costs are amortized using straight line method over the useful life. Training costs for the software are capitalized as incurred. Costs incurred for upgrades are capitalized if they meet the capitalization criteria, and cost for maintaining is expensed as incurred. What about goodwill? So how do we account for goodwill? Accounting for goodwill depends on whether it's internally developed or purchased through a transaction. All companies strive for the development through product quality and effective marketing. Internally developed goodwill distinguished from unidentifiable assets of 2 categories. It is not separate from other assets in the company, and measuring internally developed would be difficult. The costs associated with internally developed goodwill are expensed as incurred. If you purchase goodwill, there's a difference between the purchase price of the acquired company and the fair value of the assets. 4 factors can be accounted for between the difference of the value of the company as a whole. So book value minus the book value. So assets minus liabilities. So Many assets are listed on the balance sheet in different amounts than their actual fair value. Identifiable intangibles may be unrecorded or undervalued. Unidentifiable, such as internally developed goodwill or of the target company, or may not exist on the books. The acquirer may simply just have paid too much, by the way. So an example, Sarah Company acquires Trevor Company and purchases its net assets for $790,000 cash, and the independent market value of the assets results in the following. So the book value of cash is always the same. Then they have accounts receivable 180, book value, fair value 180. Inventory is book value 150, fair value 210. Plant, property, and equipment is book value 270, fair value 325. There's a trademark with no book value but has a fair value of 130, and notes payable is a negative number, so negative 530 because it's a liability. So the identifiable net assets are 145,000 on the book and 390 on that. So they would record the identifiable goodwill, the identifiable net assets as follows. So they put everything on for the fair value, and the difference would go to goodwill. It's the difference between what they paid and the assets that they could identify fair values for. Goodwill is considered to have an indefinite life. Examples of circumstances that would indicate an impairment exists include a deterioration of general economic conditions, limitations, or accessing capital, industry or market considerations as deteriorations, cost factors such as increase in raw materials, labors, or other costs, a decline in financial performance, changes in key personnel or suppliers or customers, and expected that the reported entity might be sold. Because goodwill is indefinite, the asset cannot be separated from itself. The goodwill must be assigned to a reporting unit within the company. The reporting unit is a segment or component with a discrete financial information. Goodwill is tested for impairment with context of the reporting unit. If a qualitative assessment indicates that goodwill is more than likely than not the fair value is less than its carrying value, a company must perform a quantitative impairment test. If the fair value of the reporting unit is greater than the book value, goodwill will not be considered impaired. If the fair value of the unit is less than the book value, impairment loss is computed. Fair value minus book value. The impairment loss cannot be greater than the book value of the reporting unit. Any impairment loss will be a separate line item on the company's income statement as part of continuing operations. An example, Kent Company purchased Devon Company as a subsidiary several years ago. Devon is considered a reporting unit of Kent. At the end of 2019, Devon has a net book value of $3.6 million, which includes $400,000 in goodwill. Kent determines the fair value of Devon's identifiable assets excluding goodwill is $2.7 million. To test for the impairment of goodwill, Kent compares a $3 million fair value to the book value of 3.6. This means that the fair value is less than book value, so they have a $600,000 impairment loss. Because the goodwill of the reporting unit is only $400,000, the impairment loss is limited to the goodwill, so they must just write down $400,000. It is possible that the cash paid for a company is less than the identifiable assets. In this situation is not common. It may occur if a forced liquidation or distressed sale happens. There is no such thing as negative goodwill. So if a bargain purchase occurs, there's no such thing as negative goodwill. So while IFRS and GAAP define intangibles similarly, several differences exist. IFRS allows the company to capitalize more of the costs internally generated than GAAP. IFRS allows intangibles to be revalued at fair value, so you can write them up. For intangibles with finite or indefinite life, IFRS uses a one-step approach to determine impairment. For intangibles other than goodwill, IFRS calculates impairment loss as a difference between carrying value of the intangible and its recoverable amount, not fair value. For goodwill, IFRS calculates the impairment loss as the difference between carrying value of the cash-generating unit and recoverable. And for intangibles, assets, goodwill, IFRS allows an impairment loss to be reversed, and GAAP does not. And that's the end of the overview, and we'll do some problems.